sitting in a chair just like that September last year. So interesting to be on this side of the room. Good to see you all. My name is Sree, and I'm currently building a company called Mintara Labs. One of the key things that we're building is insurance against on-chain risks. So today I'm going to talk about a very subset of insurance and hopefully get you interested in this space and at least show you some interesting things that are happening right now. I'll keep this short, but I really want to drive. I want to talk about things that are actually interesting and relevant to you. So a lot of this, there are very few slides, like 6 in total. So a lot of this will be going based off of the questions you ask or the questions I ask and the answers you provide. So firstly, with the raise of hands, how many of you are actually familiar with DeFi? Do you know what Aave is? 1, 2, 3, 4. Okay, that's okay, no problem. So think of Aave as a crypto bank. You put your money in a bank and it generates interest for you and you can earn money from that. And that's all you need to know about it. And now this is going to be important to you going ahead. But as usual with any talk, there's 2 key things, why should you be listening to this one guy here? And the second point is why should you be listening about whatever he's talking about? So credentials wise, I was a master's student here at UCL just a year ago. And more relevant to the second part of this session, which is about vibe coding. I've won 6 hackathons in the past year. I've actually only gotten into it seriously back in February-ish. So I had a pretty good success with vibe coding and actually producing something useful also. And that's what I do on a day-to-day basis now with my company. And also I have experience building companies. So I've built and exited from a tokenization infrastructure company where we tokenize assets for crypto companies. More on that later. And I've also just raised investment from an organization that does a lot of R&D in blockchain, which is closely affiliated with UCL, and Java is also part of that organization. So that's me. Now, in terms of why should you care about this particular problem, why insurance? Well, insurance is kind of like a core foundation for the real world in traditional finance. Without insurance, you wouldn't be able to drive cars because you're legally required to have car insurance. At least in the UK, as far as I know in the UK, at least in the US, as far as I know in the UK also. Similarly, there should be a parallel where crypto should have great insurance, right? But the answer is it doesn't actually currently have insurance because of various reasons, which I'll get into in just a second. But the problem is big. Without insurance, what happens is there's 1 to 3 hacks every single week. And you can verify everything I'm saying on my slides on DeFi Llama. In fact, I was going to show you, but my Wi-Fi isn't working on my computer properly. But you can check. This is publicly available information. Let me check if I can actually. Oh, it does work. Cool. So let's see. DeFi Llama is a website where there's just a bunch of information that you'll find that information that is publicly accessible on chain. You'll be able to find it on DeFi Llama for the most part. And so here's an example. So there's a hack that happened 3 days ago something called 402 Bridge on Base. It's an infrastructure project and private keys were compromised. Or there's a price manipulation attack on this thing called Arbitrum. It's a chain, it's another one. And then on Sree, there's a protocol logic exploit. You can see that. So you can go through all of these and you'll see that a lot of these issues come down to like the various types of on-chain risks that exist. One would be but the simplest one is there's a hack. You can, a smart contract has a small bug in it, which you can exploit, and you can steal a lot of money from it, or protocol manipulation or price manipulation somehow, taking advantage of admin functions. These are common problems that exist. And the reason it's a big problem is that just in the past 8 months alone, or 10 months alone, there's been a bit over $2.5 billion lost because of on-chain risks. And this number, as you can imagine, is going to get more and more, growing exponentially because of people's interest in crypto. Now, Coinbase consistently ranks as the top 200 most downloaded app consistently. Usually, like an app that's like super popular goes to top 10 place, and then it drops back down. Like you never hear from it. But Coinbase consistently within the first 100, 200 apps. This means people are constantly downloading Coinbase, which also means that it's a good indicator of people's interest in crypto in general. That's because a lot of regulation is becoming more clear. So people are putting more funds on chain. And at some point, getting a 4% return on USDC, which is a stable coin, is no longer enough. So you want to do something a bit more risky, but also more rewarding. Maybe put it in some other protocol like Aave, crypto bank. It's on chain. Maybe you could earn 8% interest on USDC there. Why not? So that's a growing problem. And a lot of the hacks that you saw, they're happening on protocols even after there have been audits. So audits are where you look at, you go through a security company, they read your smart contract, they review everything, and then if there is a problem, then they will tell you, hey, here are the problems, you should fix them. And at some point you get the report saying everything's good. And that's when you can go out and tell the world, hey, like use my smart contracts, put money in it, buy things or whatever. But even though all these banks are audited, they're still getting hacked. So that means security is no longer the issue here. There should be a way to protect depositors. And that's where insurance can come in. So insurance has lots and lots of parts in the TradFi space. When I say TradFi, I mean traditional finance. But before I go into anything further, by the way, does anyone have any questions as to anything that I've said? Any words that I've used you're not familiar with? If no one says anything, repeat everything from the beginning, along with my name and introduction. Okay, at least you're laughing. That means you're hearing me, so that's okay. That means you actually have no questions. Great. Maybe you should get tenure to be a teacher at UCL because no one has any questions. I know. Anyway, so insurance has lots of many parts, and the part that I'm specifically going to talk about today is a way to separate risk from the underlying asset. And this came from a paper I read back in January, which is also part of the additional readings. And I recommend you read it to go get a more thorough understanding as to what we're talking about today. But I'll go through a high-level overview, which kind of just blew my mind. I just never thought something like this was possible until I read that paper, and I was like, oh, this is pretty interesting. And I'll show you that. And I'll actually prove to you that this is something that's interesting. The second part is the core focus of today. We'll be talking about risk transfer. How can you transfer risk? But there's lots of other components to insurance that we're not covering. How do you price this risk? How do who pays for the risk? Where do you get the liquidity from? Or what types of risks are covered? There's so many parts of this game that are super complicated, but I won't talk about that today. It'll strictly be about transferring risk. And then, as I was saying, you should just read the paper for more mathematical background to what I'm showing today. And voila, now is the time to draw things. We're down to, this is slide 4 out of 6. So, I promise it'd be a pretty straightforward. Let me pull up a piece of paper. Let me just draw some things out. It'll be strikingly interesting to you. I'm gonna click a button here, doc cam. Okay, that works. So if I say hi, does that read normal? That reads normal. We're good. So let's draw some things. This is going to be I'm going to go as deep or as undeep, depending on the questions you ask. So because you guys said you're not familiar with Aave, I'll just give you a quick example. Wait a second, this is a website. Oh, it's not the website.
Press the left.
This is a website for it. Let's open it. Aave is really cool because it's the first one to come up with this crypto bank idea. It's called the yield protocol because it generates yields for you. And how this works is you can come here, you can click USDC, and you can connect your wallet and put your money in. And when you do, if you supply USDC, you get paid 3.67% a year. if you borrow USDC, you have to pay 5.24% a year. The great thing is Aave is not like a bank where some guy sits behind a chair and does some numbers to figure out how much you have to pay. It's one of those things where the market decides. How does the market decide? Well, that's where this liquidity comes from. There's $5.2 billion available for people, or $5.2 billion that people deposited. And then there's $4 billion that people are borrowing. And these numbers somehow get you a percentage of yield. And then it tells you how much yield you get if you deposit, how much interest you have to pay if you borrow. So example of a crypto bank. Now let's go back to this. So I'm a user. I put $100 in. That's USD. And what Aave does is there's borrower. I know my handwriting is shit, but it's okay. You'll bear with me today. So supplier. So I'm a rich guy, so I put $100 in. You know, Tammy's a rich guy, so she's gonna put $100 in. I'm a poor guy, so I'm gonna borrow. You know, I'm gonna give Aave. Actually, this is not important right now. I'm gonna borrow $100 from Aave, and I'm doing, you know, I'm living my life. So what happens is, what if, like, Tammy has $100 today, but tomorrow she needs to buy food, so she needs to get her money back. So she wants to come and borrow or withdraw her money, but then if Aave, like, there's like a bunch of dollars, like 10K dollars. So because Aave has so much money, at any point you can just withdraw this money. But you should only do that if Aave itself has money, right? So what happens if there's a hacker who comes and hacks from Aave? This means that the money is going to be lost and she'll never be able to withdraw her money. So you need some sort of protection for bank A so that depositors can always get their funds back. So how to make that happen in a clever way? So that's what this diagram is going to be about. So what if there's a middle layer? So instead of, you know, what Tammy cares about is she cares about, I'm sorry to be using your name so much. Maybe I should convert back to me. So what I care about is I want to make as much money as possible, and I don't want to take the risk of losing my money, right? So what I'm going to do is, this is a good sign. Everyone's eyes are on me. I love it. So what this means is all I care about is making money. So scratch me putting in the bank. Who cares about the bank? What I care about is making money. So I'm going to put money in this thing called branding, CoverMax. That's the name of my product. And then, you know, I put $100 in, and then CoverMax takes your money and puts it in bank A, bank B. That looks like bonk. Don't buy it. It's a bad investment. 50. Bonk is a meme coin, so it's a bad investment. So it takes $100. It puts 15 to bank A, 15 to bank B. So at least first, all that's happening right now is you're diversifying risk. So if bank A collapses, you still have $50. Now let's take this a step further. If I give the depositor these things called, I mean, how does a depositor, like, how does CoverMax, which is a smart contract, how does a smart contract know how much money the depositor deposited in? Like, how does it know I deposited $100? I don't want it to keep track of my wallet address, because today I have wallet 1, but tomorrow I might have wallet 2, wallet 3, wallet 4, wallet 100. So since it doesn't know my real name, it just knows what wallet I use to deposit, it would be pretty bad if the contract took your money and remembered it. Oh, you know, Sree put money in from wallet 1, and then tomorrow, if you don't have access to wallet 1 again, you lose your money. So that's pretty bad. So you want to give these things called receipt tokens. You want to give a receipt to the depositor who basically puts their money in, so that they know, well, so that the contract knows that if someone gives me the receipt token, that means they have at some point deposited money. So here I give someone 50 S senior deposit tokens, 50 junior deposit tokens. So again, let's take a quick step back. So without going any further, if again, Tammy now is stuck in my mind. I meant to say Sree. If Sree deposited $100 into CoverMax and he gets 50 senior tokens, 50 junior tokens, this means that at some point I want my money back. What I do, I just return my 50 and 50 senior, 50 junior, and then it returns back my $100. Let's start with a cleaner example again, now that we've understood what receipt tokens are. So now here's the beauty of this. So there's CoverMax, there's a depositor, $100, and this depositor gets 50 senior, 50 junior. And by default, I mean, you don't have to give him 50 senior, 50 junior. You can give him like 99 senior, 1 junior. The point is these add up to 100. And you can always return one of these receipt tokens in return for one underlying dollar. Cool. So now, how does the risk transfer happen? Well, as we know, CoverMax puts money in various banks. In this case, it puts $50 in A, $50 in B. Again, here's also a different one. It does not necessarily have to put 50 and 50. You can do like 99 and 1. I mean, there's no hard rule on what you should do, but it just makes sense. You know, we want to put it equally, because if one gets hacked, if there's an equal probability of both of them getting hacked, you might as well just put equal money in both. So it's fine. Let's just put some money in it. Cool. Move on. So now, here's where the beauty is. Now I need to actually use Tammy. So let's use Tammy. So here's Tammy. Just thinking there's no space. Okay, Tammy also has $100. Actually, Tammy's rich. We'll give her $200. So now she gets in return 100 senior, 100 junior tokens. Let's separate Tammy and myself. Okay, does everyone understand that it says 100 junior? It looks like a scribble, but that says junior, trust me. Okay, so let's look at some reserves. So we know that based off of all these deposits, there's 2 users using CoverMax now. There is like CMX, short form for CoverMax. CMX in total has $300 in reserves. That's because Sree put in some, Tammy put in some. 300, 100. Okay. Bank B. The reason I drew this is because there's a secondary market now. Because there's these senior junior tokens. They're just tokens. You know how you can like buy and sell Bitcoin on a decentralized exchange? Are you guys familiar with what a decentralized exchange is? Decentralized exchange. Okay, awesome. So for those of you that don't know, think of Coinbase. Wait, how many of you know what Coinbase is? That's okay. So think of what's a fiat exchange? There we go. So if you want to, actually, no, there's no good example. So just imagine like Coinbase being a market where you can go in, you can give it $5, you'll get $5 worth of Bitcoin back. It's an exchange. If you want to sell your Bitcoin, you give your $5 worth of Bitcoin back, and you get $5 back, currency. So it's just an exchange where you can buy and sell crypto. But imagine that in a decentralized way. In a decentralized exchange, what happens is it doesn't actually know who you are as a person. There's some people that provide liquidity. So if like in a basket, wow, easy. So if there's 100 Bitcoin and then $100, I'm Sree, and I have $100. Let's say I have $10. I give this $1 and I get 1 Bitcoin. That's because the ratio is 1 to 1. But then if I give another $1, right? I have a simpler example. I did not prepare to talk about exchanges. Sorry, I didn't prepare for this particular example. But so I give $1 here, actually $1, and then I get 1 Bitcoin. That's because the ratio is 1 to 1, right? But then right now the new ratio is going to be 11:9. So if I give $1 more, I'm going to get like less than 1 Bitcoin, less than 1 Bitcoin. Bitcoin. But that's because the ratio now is 11 to 9. It's not the same. So this, if there's liquidity in this decentralized exchange, you can just sell as much as you want, you can buy whatever you want, but the rates, the prices will always be determined by the ratio of the two baskets. Are you able to see how my numbers, even though they're small? I actually didn't realize they're this small when I was writing it there. Maybe I'll write bigger going forward. Anyway, so now we can create markets for senior, and junior tokens. And the beauty of this is, imagine there's like tons of liquidity. So an infinite amount of senior and junior tokens, because since I have 50S and 50J, Tammy has 100S, 100J. If I want to sell risk, I actually haven't specified what senior and junior is in this example. So let's senior and junior are basically almost the same thing, except senior tokens get liquidation parameters. What this means is at any point you can deposit your senior tokens, you can give it back. In this case, this is the receipt example, right? So in this case, at any point I can return my senior tokens and withdraw liquidity, so I can remove funds from a certain bank. Junior tokens, I have to wait 3 days. If there is a hack, I have to wait 3 days. If there's no hack, get it immediately. So in this example, if I don't want the risk, just bear with me with this example. I don't want risk, so I'm going to sell my 50 junior tokens, and then I'm going to buy like, based on the price, maybe like 48 senior. So this means I will have 98 senior tokens in total, and which means my redemption is for $98. So I lost $2 there. That's because I actually sold risk. I'll tell you why. So if there was a hack, let's say Bank B gets hacked. Bank B currently has $150. Bank A currently has $150 if you put it in equal. But we just lost this $150. So this means that if I go to the bank and if I go to CoverMax and say, hey, like I have 100 senior junior tokens, I want to remove liquidity, there's only $150 left. So if Tammy also goes, there's no money for both of us. Does that actually make sense? Do you see how we put $100 and $200 is equally deposited? If one bank gets hacked, there's only $150, but we put in $300. You see how one of us is going to lose $50 somehow, or we just lost $150. So I, for sure, if I remove my $100, she won't have any money. If she remove the 150, she still lost 50 extra dollars, and I can't even get my 100 back. This makes sense, right? You see where the loss comes from? I need a nod, guys. I can't tell. Yes. Yes. No. Yeah. Okay. Good. So, so in this example, like there isn't sufficient liquidity. But if I had 50 or 98 senior tokens, since I have senior, I have first preference for this $150. And that means Tammy has to take up the loss because she holds the junior tokens. Processing, yes.
So you're basically an insurance company?
Yeah. Oh yeah, it came in late. Yes, that's exactly right. Understood.
But like if there are more senior tokens than the liquidity currently the CMX has, then what will happen?
There will not be more senior tokens because CMX issues the senior tokens equally along. So if CMX has a liquidity of 100, there will be at most 50 senior tokens. If CMX has a liquidity of 100,000, it will have at most 50K senior tokens. There will always be half of total liquidity available will be senior tokens. The other half will be junior tokens.
More than half get to.
Then even the senior token holders lose funds. Exactly. Yeah. So in this example, that's actually a good question. If there's more than if like 80% of total liquidity gets stolen from the underlying banks, then yes, even senior token holders lose value. But the thing is, that's not realistic because if you put, in this case, there's only two banks. Imagine if you have like bank C, D, E, F, like you expand this out to like 10 banks. If one gets hacked, that's only 10% liquidity that's gone. If you're assuming equal amounts of liquidity are put into it. So you have to do it in a way that the banks are completely all uncorrelated. So they're not putting their money in a different bank. If you make sure that's true, then we'll almost never have, it's very unlikely that you lose more than 50% of liquidity. So that's exactly right. So senior and junior tokens are just liquidation preferences. So to keep it simple, we'll go back. Next, I put in 100. Again, 50 senior tokens, 50 junior tokens. Based on how much risk I want, if I want 50% of my funds to be protected, I keep it at this ratio. If I want 98, so I'll keep this 50. If I want 98% of my funds protected, I'll get 98 senior tokens and then 0J. If I want to make money, here's an interesting way to make money. What you can do is you can sell your senior because there's the liquidity pool, right? So there's the SJ. People want protection. So there's people that are willing to sell their junior tokens. People are selling their junior to buy more senior. That means there'll be less than 10. There'll be less than 10 tokens in S, more than 10 tokens in the J pool, which means the price of S is higher than J. This means that, if I want like no protection, if I want 0% protection, it's crazy because I can make tons of money. I can make, like, I can have I have 0S and then 108 J. That's because the price of J in the normal markets would be lower than senior because most people will want to buy protection, right? They'll want senior. So the price of J will be lower. So if you want 0% protection, you can go all in. Now that's 108 token, 108 junior tokens, which means your yield, if you started off with $100, your yield is 8%. instantly. You're not waiting a year, it's instantly 8%. So that means there's someone willing to buy the risk. So there's always going to be these pools where people will be buying and selling the risk. And yeah, that's like the simplest way to explain CoverMax. I realize it's a bit more complicated because I had to explain what the decentralized exchanges are. But the paper that you'll read in the wrong button. The paper you'll read in the additional readings will have this diagram. You'll have this diagram where it talks about the phases. So the contracts are deployed, CoverMax is deployed, people invest money. So I put in 100, Tammy puts in 200. And when people put in their money, this money is put into the various banks. And then when CoverMax puts this money into the various banks, or in fact, when you actually deposit your money into CoverMax, you as an end user get a bunch of senior junior tokens based off of what protection you want, 50%, 98%, or 0%, you'll buy and sell the senior junior tokens. And then you'll just wait. And at some point, at the end of the week, you can choose when T1 is. So let's say if this runs in 1 week cycles, at the end of the week, you'll check, is there a hack? If there is no hack, then we're able to return our senior tokens or junior tokens and get liquidity. But if there is a hack, all S token holders, so the senior token holders will get first priority. So in this case, it says A, but think of it as senior. So they'll get first priority to take any liquidity from the unhacked bank. And then at T equals 3, maybe a day later, maybe 3 days later, you can take liquidity from the unhacked, any remaining liquidity, if there is. So the J holder, the junior tokens, can take liquidity out from if there's any remaining liquidity. But there's some interesting things that you can do in this period of time. So one example was you can sell your risk. So you're buying your J tokens, buying as many as senior. So that means your redemption amount is going to be less than your initial amount. If you had $100, you sell your J tokens. That means you're going to have 98 S tokens, which is your protected amount. But then on the other hand, we gave this example of, if you sell all the senior, you'll get a bunch of junior tokens. So you'll get your insurance, your risk tokens, your J. This means that at the end of the cycle, if there was no hack, you can return either the J or the senior token to redeem $1, right? There won't be any at that point. That means you can return all of your J tokens, 108 J tokens, and take $108 in cash. And the amount of J tokens you get for the S tokens you sell is determined by the liquidity pool, the decentralized exchange. So that's where the risk transfer comes from. It's very simple, but I think I kind of overcomplicated it. But I hope it makes sense. Does it make sense? Is there anyone that it did not make sense to? Feel free to tell me. We have time, so I can quickly go over something. No? Okay, cool. Anyway, so that's like the complexities of the protocol. Read the paper, it kind of talks about it too, but in a more mathematical way. So as I was saying, we only talked about transferring the risk. We did not talk about other components. The other components being pricing the risk. How do you actually price the risk? That's actually a very difficult thing to do. That's where a lot of existing insurance protocols actually failed. There's only one that kind of got it right, but it has problems. Another one is, how do you trigger a loss? So in the example I gave you earlier, I kept saying, like, if a bank collapses, so and so things happen in the contract. The thing is, how does this smart contract know that those banks actually collapsed? So you need to figure out somehow, CoverMax should know how that a bank collapsed. That's something to be figured out. Well, there are answers for it, but I won't tell you. And then you have to figure out the user experience. everything I explained with the senior and the junior token is kind of complicated. So it needs to be a simple way to kind of, for an end user to just buy and sell. I mean, the simplest thing is just say, hey, there's a premium. There's a $2 premium if you want to buy protection for $100. That's basically what it comes down to. I could have just said that, but you wouldn't understand the underlying mechanics. But that's basically the simplest way to explain it. And then there's also protocol extensions to cover other sorts of risks. We only talked about banks getting hacked, but there's other types of things that can happen. What if you forgot your wallet key, private key, so you don't even access your funds anymore? You can't really do much then. That's not a risk that's covered by the insurance. So there's only some that are covered, some that are not covered. So how should you expand these to other risks? That's something to also be figured out. So these are things we did not talk about, but these are things I'm pointing out because if you're interested in it, you can come speak with me and I'll kind of tell you a bit more about it. Interesting things though. Do you guys know what prediction markets are? Please raise your hand if you know prediction markets. It's like
Fully market.
exactly, poly market. So it's like prediction markets are almost like betting markets where you can just say, hey, is Trump going to win this election or no? Or is it going to rain tomorrow or no? Yes or no? You bet on one thing or the other. So there's these sort of betting markets. If you say, is bank A going to get hacked in the next week or no? Is bank B going to get hacked in the next week or no? You have like a bunch of these prediction markets. Then the aggregated, these prediction markets kind of help determine the price. Sorry, they determine the risk level, which also determines the price. But this only makes sense if you're assuming that people that are actually doing the betting, predicting whether bank A gets hacked or not, are people that understand stuff. They're not just speculatively trading, betting on bank A getting hacked or not. So prediction markets are a good use case to price risk. Loss events, you can also use prediction markets. Did bank A get hacked or not? You can ask that, and then people will be willing to bet on that. Or you can just use oracles to figure out. Like the oracles is a bit more complicated, so I won't talk about that. So those are some interesting ways you can use kind of more. These are like the hype talks. Like prediction markets are like the really big thing. Stablecoin is like the really big thing in crypto right now. So that's the reason why I kind of brought it up. But if you're not sure about that, then if you weren't sure about that, then it's okay. It's not relevant to you. There was going to be a vibe coding exercise, but there's 10 minutes. I could do some really short thing, but first I want to ask, do you guys actually care about vibe coding in an effective way? I need hands. Yeah? That's like 3. Okay, so we don't do it. But we do it. Vibe coding.
Yeah. So like what does it mean?
Ah, I'm so sorry. I am so sorry. I'm so sorry. I just assumed everyone would know that. My fault. Thanks. That's a very good question. So vibe coding, I should have said. So basically, you know LLMs, right? The whole AI thing. So there's these really cool things you can do with LLMs where some of them are really good for coding. This means you can code much, much faster, like 100 times faster, without actually knowing how to write the code because you can use LLMs. Because so this is something interesting to you, right? This makes sense. You can do interesting stuff. Let's make something happen. 10 minutes. I'll quickly run something quick. Let's close this. I'm so sorry. I just assumed everyone would know what vibe coding is. That's entirely my fault.
Everyone does it, but like they won't probably know
the name of it. Oh, okay. All right. I was going to vibe code the contracts, the insurance contracts a bit, but I think I'm going to keep it even more basic. The thing that's vibe coding mainly used for nowadays is creating websites. So let's make a really quick website really quick. Can you actually read anything at all?
Try to share screen.
Yeah, let me try now.
Mm-mm. Oh yeah,
It does show. It works.
Yep, it was.
Nice. Okay.
So nobody had any questions about the insurance protocol?
Yeah.
Yeah.
questions.
Okay, let's talk about that before I do this thing. Yeah.
Okay, I have two questions.
Yes.
One is that your company is a insurance company, so why don't we just come for official insurance company to do that we use such a complicated mechanism to insurance our assets.
Perfect. So traditional insurance cannot underwrite risk, crypto risk, because one, they don't fully understand it. Two, traditional insurance companies get their liquidity from other financial institutions, pension funds, for example, or sovereign wealth funds, for example. Like there's a lot of liquidity. There's very strict rules as to what you can do with that liquidity, like what kind of risks you can underwrite. And they wouldn't want to take something on as risky as crypto.
So it's
That may have
not covered
backwards. Sorry?
It's not covered by the insurance.
Yeah, it's not covered by insurance company, and it will not be until there's a lot more regulatory clarity.
And my second question is that because I think that the DeFi is backed by blockchain, and blockchain, if you want to do the hack job, you want to attack it, you have to master half of the, let's say if they use the POW, you have to master the half of the computational power. So how does they do that if they want to manage a successful hack?
So hacking a blockchain is very different from hacking smart contracts.
Yeah.
A smart contract is just a piece of code that runs on top of blockchain. So hacking smart contract is very easy. Hacking blockchains is very hard.
So I think like Coinbase, I think in the example is one of the bank, right? The Coinbase exchange.
No, Coinbase is more of a, it's not on chain. Coinbase runs everything off chain, so I wouldn't cover Coinbase. But Aave, like what I showed earlier, this is on chain. So it runs fully on smart contracts. So that's what will be covered.
So like such a big company, such a big bank, they will be hacked. Why you won't be hacked? I think like you are insurance a new currency, new tokens. The token is a brand new currency. So like if the big company will be hacked, why you won't?
Very good question. So this is the reason why. Trying to find a contract. Basically, this is the GitHub for the crypto bank I just talked about. The code is fully public. Anyone can use it. Anyone can. And okay, well, this is just an example, but look at the type of contracts that they have. I'm trying to show you the complexity of their contracts. So I already clicked deployments. What type of interfaces? There we go. These are all interfaces. Interfaces mean it's like a boilerplate template for more complicated smart contracts to be created from. So just interfaces. And look how many interfaces there are. For example, look at like interface this. This just talks about what the function is and what its input parameters are, what the outputs are. It doesn't actually write the function itself. You have to write the function separately. So there's like so many contracts. There's so much complexity. There's like oracles. There's this. There's that. There's so many moving parts. Hacking them is much easier than hacking me because I have like one contract with maybe 80 lines of code. Because it depends on the complexity of the contracts determines how hard it is to actually hack. Or like if you're trying to deal with prices, you're trying to deal with people's deposits, you're looking at so many things. The more complex the system, the more harder it is to the easier it is to actually accidentally have a bug in there. But if you have something super simple, very clean, that does two functions, then it's much more difficult to get hacked. So I understand your point of like, if they can get hacked, why can't you get hacked? Well, they can get hacked because they're much more complex. But there's not mean that you can't get hacked. You can also get hacked. But the point is, would you rather get one insurance protocol audited 100 times than pay a lot more money to check every single bank that exists, like audit every single bank multiple times. So it's much cheaper, much more cost effective to just audit something like insurance, which is like a much smaller contract with much fewer moving parts, much cheaper cost, and you just do it so many more times. It's just much more cost effective, and like it's a safer bet to take.
I also have a few questions.
Yeah.
So, first of all, maybe I didn't understand the way you presented the mechanics of selling senior token for some premium. It sounds like an infinite money glitch, right? Because you said something along the lines that, okay, I'm selling 100, I'm getting 108.
Yeah.
But from my understanding, I can go directly to the protocol if there's no hub and just withdraw and make profit at that point, right? And then I can do that cycle indefinitely. So maybe there is some details that
Yes. So
we didn't cover.
You will not be able to take money out of the. Yeah, that's because I didn't cover a key detail actually, which I thought wouldn't be important. So when you deposit funds into Aave, you get Aave's receipt tokens. So if you put USDC in, you get AUSDC. The AUSDC is held by the CoverMax contract. So in this example, when you put bank A, it gives you a USDC, and that's held up in CoverMax contract. That never reaches the end user. So the end user will not be able to withdraw from bank A default directly. They will not be able to withdraw from B directly or C directly. So they cannot reuse those funds.
Yeah, but let's say my understanding is that we have USDC tokens, right?
Yeah.
Or any token. For this token, like when I submit it to CoverMax, it's more like an aggregator rather than traditional insurance, right? You aggregate, you have different strategies, and you're trying to build on top of it a premium mechanism of if something goes bad, then you have basically some priority, but it's not really priority, right? It's that amount of money will be able to recover if only part of the vault gets drained because of another hack. So it's not priority, really, it's complete risk, if I understand correctly.
No, it is still actually priority because you put $100.
Priority means that I will be able to get my funds back eventually.
No, you'll be able to get your funds back from all existing liquidity. So there's a bunch of platforms the money goes out to.
For a single token, right?
For a single token.
Or you aggregate the tokens.
You aggregate the token. So you get maybe 50 AUSDC.
No, like the first inputs. Let's say we have USDC and we have also USDT.
Okay.
Do you aggregate them in the pool or no? Or you have USDC and do you aggregate them in the pool?
No. So I'm talking about, just assume only one asset is deposited. So only like USDC is put in, but.
So it's basically like a single pool market, right?
Yeah. So this only, in this example, this only looks at state like USDC, but puts it into a bunch of banks. And then it locks up the receipt tokens from all these banks. So that's CoverMax's liquidity. Because it has, it gets 50 AUSDC and then 50 BUSDC, 50 CUSDC. Receipt tokens from bank A, B, C. So this is liquidity in CoverMax.
Yeah.
If you want to sell your risk, like here, you're exposed to, if you have 50-50, if bank C gets hacked, there's only 66% of total liquidity left. So that means you will be able to get 50, you'll deposit 50. So you'll get $50 back. When you deposit your 50 junior, you can only get the remaining.
In this example, you can get
23 back.
But
26 back.
Yeah.
Or 16 back actually. So that's
so if nobody claims though.
If nobody claims, then there's no problem. The thing is,
but you said there's a delay. So I have some senior tokens, I claim them, but other people that do not have senior tokens do not claim.
They don't claim. Okay.
So after the timeout, I can claim my junior.
Yes.
And the other people with the senior tokens actually they lose their funds.
If they don't withdraw within that window where senior has priority, then yeah, they have equal priority as junior tokens after that period. So yeah, they will lose funds. But thing is, like, from a practical perspective, so I see that, okay, that seems a bit useless. What if I just don't withdraw within that period? I just lose my money, right? But in a practical world, people that do buy insurance, they would want to set up an automated bot, or like they would pay a company to set up an automated bot so that they can immediately claim all their senior tokens when the hack happens, like within that window.
And for the yield, you do basically yield aggregation.
Exactly. For the yield, it's aggregation from all the various underlying tokens.
So you also have that logic in
Exactly.
that.
Exactly. And this is why you'd want to.
Now, can you explain a bit more, like, because as I said previously, like you presented in the first place, it seems like I can always print money
Yeah.
if I'm selling my senior and nothing bad happens in the protocol.
Of course.
How
So
does it
the
work?
reason that it seemed like infinite, even though it's not really infinite, is the only reason for that is I didn't actually show much about the liquidity pools.
Mhm.
So let's take Uniswap. Imagine there's a market for you to trade S and J tokens. Initially, since there was only one user, there is no liquidity. Maybe I personally would put in $100, right?
Mhm.
So once I put that in, every time like you sell junior and buy senior, this drops, this 100 tokens now only becomes maybe 50, and this becomes 150. Now there's a price difference, right? So this means that senior is going to be 3 times as much more expensive than junior tokens. So that's why, like, it seems like infinite because you're selling
Yeah.
senior per junior. That's
So if there are enough risk takers, basically the value will go to 1-to-1.
Exactly. So there'll always be a balance between, there'll be a bunch of people that sell their junior to buy senior, and there'll be a bunch of people that sell their senior to buy junior. So you'll try to be as close to one as possible. So maybe in practical world, the price will be much more closer. So it'll be between like $1.02 and then 98 cents,
Mhm.
senior and junior prices.
And you don't care at all about the risks of the underlying assets.
The risk of the underlying asset. Oh, as in like the actual stable coin.
Yeah.
Yeah. In this example, there is no stable coin insurance. This is only for the underlying protocols.
Pools.
Exactly.
My question.
That makes sense?
You're lying. I'll quiz you afterwards.
Yes, my question is like, company is full-fledged running, and I come as a user, and I deposit maybe $100, and I get 50 of those, and then I go to the pool and I convert all of them to J tokens, so I get 102, and then next week I extract all of them out. So now I've made a profit of $2, and then I do this again and again until the value of J is higher, until like the value of J is higher than S. And so at one point in like people they will both become equal.
Yeah.
So when I do that till that the value becomes equal, and I sell my J tokens again and again to the lender.
Yes.
So I made a profit, and then technically like the whole liquidity pool, the values have also crashed as well.
No, the assumption you're making is you're the only one trading with the liquidity. But if I'm also trading, I see that you're buying juniors. So that means the price is getting closer and closer to
Yeah.
1. And then when it gets closer and closer to 1, if you're making profit, that's fine. I want protection, so I'm going to buy as much senior as possible. So that means the price goes back down. You see what I mean? Because every time, like, junior is never going to go above senior, because if the price of junior is like higher than senior, everyone's going to buy senior tokens, because like that's amazing, that's perfect. That's like you're getting paid to be insured. Does that make sense?
But yeah, I understand it. But my question is, I do this till the value becomes same. So I've made a lot of money
Yeah,
from like.
you have.
And I haven't even like there's no hacks, so like I make a lot of money.
Exactly. But if there is a hack, if you going back to your example, you start with $100, you put it in, you have 102 J tokens. If there is a hack, say bye to all of your 102 J tokens. You cannot get dollars back. It's worth nothing.
Yeah, I understand that, but like normally in insurance you have to keep the amount for a specific period, or like there's the limits. Like I can just withdraw it immediately, or there's like a weekly cycle or something. Like if I deposit money right now and I can tokens, and I can immediately withdraw 102 tokens, or is there a limit?
You cannot immediately withdraw. Because if you can immediately withdraw it, everyone's just going to convert to J and then withdraw. So you'll lose liquidity. So you'll have to wait until the 1 week period ends, and then you'll withdraw. So if you have $100, you put it in, you buy a bunch of junior, so you have 102 junior, 0 senior. You have to wait until the end of the week for you to just return your J tokens and remove your funds. During the week, if you want to withdraw funds, what you do is the contract can require you to have equal amounts of senior and junior. So you have to sell half your junior again. So maybe go back to 50-50, and then you can return it to the contract, and then you'll get your $100 back.
I didn't understand last question.
Sure. So there's what's the best way to show this? There's 2 phases. That's it, 3 phases. 1 week, week 1, week 0, and this is the period. So I put in $100. So I put in $100. Arrow just signifies I put it in. Okay, and then I get 50 senior, 50 junior, and then I convert it to 102 junior, right? So scenarios: 1, I withdraw mid of the week, so week 0.5, or I can withdraw at week 1 at the end of the week. So if you do it at the end of the week, it's simple. You just return your 102J, and then you get your $102. But if you want to withdraw in the middle of the week, what you have to do is you have to convert symbol back to 50 senior, 50 junior, and then deposit basically in the middle of the week. You have the contract can guarantee they require you to have equal amounts of senior junior tokens if you want to withdraw liquidity. So that way you're protected against all the people that are just trying to steal liquidity.
Yeah, middle of the week is fine, but like if I deposit 102Js, then like the pool is imbalanced, right? Because I just removed 102Js from the entire.
But don't forget that
the ratio of S to J should be equal. Like
in total, S and J will always equal like in CMX. So if you have 102J, that means there's some guy out there who does not. So they'll like if no matter if J, the amount of J that you're depositing or senior doesn't matter. At the end of the day, S and J are always equal to liquidity in CoverMax. So if you made $2, someone lost $2. I mean, someone else paid the premium basically.
One other question is like it's one-off pool, right? If there is an attack, the pool will basically get drained. In a sense, everyone will try to get their money back, so it becomes unusable after a fact.
Which pool are you talking about? Like these?
SMX.
Oh, CoverMax. CoverMax is a smart contract. That's a
smart contract. I mean, like if one of the underlying protocols get hacked, then actually you will need to create a new mark, a new.
Exactly. Then you'll basically remove the connection to that one bank, and you would have it at a separate bank, or maybe like.
Probably, I guess you will have to shut it down, right? Because everybody will want to exit CoverMax because. And it's if I get it correctly, it's a race who will be able to exit Earth, depending on the percentage, etc. So if there's a hack, basically the whole smart contract will get drained. Everybody will exit.
Yeah, if there's a full bank run, people. That's it. Yeah,
it's the logical action for anyone in that smart contract to actually exit.
Yes, but in practice, you may not want that because I mean, in this theoretical hypothetical world, you're putting equal amounts of money in a bunch of banks. But in an ideal world, if I
But
know,
like you have emitted some tokens, right? And you don't have the equivalent value of those tokens to support them. So it doesn't make sense for anybody to stay in that pool, right?
yes, in the way this is currently designed, yes, I agree. It will be if there is one hack, everything will get drained, but drained in the sense that the depositors will just withdraw. There will be a
Yeah,
bank
yeah,
run. There will be everyone will take liquidity.
There's a bank run, and the last that stays in the pool basically will lose all their funds.
Exactly.
Okay.
And the people that are not protected, basically the people that have the J tokens, or the people that did not withdraw in time, they will be the ones that lose their money. That's correct. The way this is currently designed, yes. But that you wouldn't, in practice, you would evolve this mechanism where depositors don't put their money in all the banks, they only put money in subset of the banks. This way, if you know that your funds are not in a certain bank that got hacked, you wouldn't really withdraw liquidity from CoverMax.
My question is like, expanding on the point Professor raised, like, shouldn't it be like if I have a J token, then I like withdrawing the total money should depend more on like the equal probability, like if 10% of the entire portfolio is hacked and like 50% is S, 50% you get their amount, and the remaining 40% is divided among the 50% of J tokens rather than the first come first serve, because that will like after just after one hack, everyone will like lose all their money. So there will be a race to like extract the money.
It's basically who is willing to pay the most to like Flashbots or whoever can put your transaction first, right? So it's actually an MEV problem if you do it like as you describe it.
In this example, yes, that is correct. But if
So who profits is the Ethereum validators or like whoever saying you are.
I mean, they'll always profit no matter what happens on chain.
Yeah, but like your mechanism designs here, it's actually beneficial for them.
Not
Because
really.
if there's a hack, like there's not enough liquidity, what I will go do, I will go and spend as much as I want. It's basically an auction who will pay more to the validators to get their transaction first.
That is true in the most extreme scenario, but that's not actually true in most cases because like if there's
Not really, right?
here's an example. Let me give you an example. So there's 10 of these, 1, 2, 3, and there's one hack.
Mhm.
That means there's 10% of total funds that are gone.
Mhm.
If CoverMax CMX has 100 in liquidity, that means 10% is gone, so this now becomes 90. This means that there will not be a bank run. There's no point. Like,
Why?
that's because even if there is a bank run, if you have senior tokens, you're protected. You don't need your like there's no need for hurry because there is the liquidity for all S token holders. If there's 100,
But there
Initially-
is a timeout, right?
there is a timeout.
If I don't withdraw, then like the junior token holders will withdraw, and then the senior token holders that didn't withdraw
They will
will
lose.
actually.
That's
lose
correct.
their funds.
Exactly. That's
So there's always the incentive to act fast and pay the higher fees or the higher bribe to validators to get your transaction first.
But the thing is, that's only true if the time frame when you have the senior token, if it has a priority of 3 days, then you don't really have to pay that much for validators to get your transaction up. As long as senior token holders can withdraw within those 3 days, it's fine.
Yeah, but then whoever stays in the protocol, right?
Yeah,
Has
whoever
to-
is in the protocol, like if when this preference is gone, then you might have to rush. If you're still a senior holder after your preference is gone, then yes, you will have to rush because you're going to be the one that will be losing. You'll lose 10% of your money immediately. So that is correct. But the thing is, in practice, no one will actually
and
do
it's
that.
not really, right? It's more like a zero-sum game. Or like whoever stays last lose all his money.
That is true. If all the junior holders withdraw before the
With
senior
the-
holders, then yes, that is
No,
true.
I mean like even for the junior holders themselves, right?
Mhm.
Let's say all the senior have withdrawn. Then for the junior, it's a race who is going to withdraw because whoever stays
Withdraws
last
last will lose.
basically lose everything.
That is true. That is true. With the way I described it here, that is correct. Yes. But there's actually protection in the paper where that will actually not be the case, where like it will be evenly distributed amongst all junior holders, regardless of your um, deposit when you actually withdraw. But in the way I described it here, you're right.
So basically, the senior can withdraw, and then like whoever stays in the protocol, they gets divided like whatever the liquidity of the protocol is.
Exactly.
So they lose out regardless if they withdraw or not.
Who loses out?
The juniors, they just lose that.
So they take the loss basically.
Yeah, there is
So there's no
one
rush to.
exactly. So that's one design of the mechanism.
I see.
It depends on what like this is all like a hypothetical thing. It was all mathematically written. So it's like depends on what proves to be the better use case in the real world. They said just do that. But there is one mechanism where there is no longer a race for you to be the first one to withdraw your liquidity from CoverMax. In that design, then yes, like the losses are distributed amongst all the holders. And then in this example, the one I described here, yes, there is a race for people to withdraw as first as possible, as quickly as possible.
Okay. And one last following question. I guess you presented the whole protocol with the other example. It makes sense because it's the largest one. But in my understanding, in my opinion, it doesn't make any sense for to do it like in a protocol like Aave or Uniswap, because there's no incentive for somebody that has their funds to Aave. It's according to their track record, at least.
Yeah,
They are the safest, right?
exactly.
So I guess it only makes sense to go for like the most risky protocols that are out there.
Exactly. That is exactly right.
So
I
I have
think
one question, one final question.
So I have some question. If the token can like tradable between token S and token J, and then when one protocol got hacked, why not someone who hold the token J just swap to token S and redeem? And then if that scenario happen, everyone gonna get some loss because token S gonna have like the price of token S gonna increase, and if the price of token S increase more than the initial price interest, they're gonna drop down. So the token S holder also gets some loss, and token J holder also takes some loss. So my question is, what do you think about this scenario?
Yeah. So the scenario for what you described, for it to play out, people should be able to trade. Like people will trade S and J after a hack.
Yeah.
That's a requirement for your scenario. But in practice, if I provided liquidity to the Uniswap pool that has S and J tokens, I want to pull my liquidity out as quickly as possible because I want to be protected. Because for me to have S and J in the first place, I deposited funds into CoverMax.
So the first mover is gonna be, I mean, whoever like, if the liquidity provider pull the liquidity out first, nothing happened. But if the token J holder swap to token S first, so everyone gonna lose.
How should describe like the later part, and to correct me if I'm wrong. Basically, it's equilibrium price, right? Because when the hack happens, like whatever percentage is lost, then basically all the junior tokens, their actual value, their market value, is whatever like you have put in minus the amount of the attack that happened.
Yeah,
Right. So let's say the price of the junior token, the redeemable price of the junior token will be 95, right? If it is the whole price, it's 1, and there's an attack like, let's say, 2.5%, then the value of the redeemable junior token after like all the senior token holders withdraw, or the amount that stays beyond the pool, so it's a bit more complicated. That is available for withdraw, and it still stays in the pool. There is an equilibrium price, right, which is more than 95, which will be the price, 0.95, which will be the price for junior tokens to withdraw after everything settles down. So I guess also for the liquidity provider, it depends on what is the price at the moment the attack happens, right? Because if the price is higher of the junior token in the pool, then it makes sense for the liquidity providers to withdraw everything. If the price is at that amount, then it doesn't make sense to withdraw. Does it make sense? So it depends on the size of the attack and how much was the premium trading before the attack.
Yes.
Let's take a